This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, you got US economic data. It's once again looking to cast a shadow across the whole of the Asian region. But of course, there's also those numbers that came out of Japan around inflation to watch as well.
Yeah, potentially. Does that sort of push back the efforts from the Bank of Japan, right, with this idea that the cost-push inflationary side is really being exacerbated by the weakness that we've seen in the yen? But, Belle, after the excitement of Nvidia, and of course that excitement is still there, but we are seeing very much that kind of return to reality when it comes to, you know, do we see major central banks led by the Fed staying higher for longer? And what does that mean for, I guess, sustaining the momentum of this rally?
Yeah, well, certainly Fed high for longer is going to really be playing into the direction of the Japanese yen, because we were speaking with our reporter Michael Wilson saying that really just everything is converging for further yen weakness from here. So you're just trading around that 157 mark today. As we said, we had that Japan inflation numbers out earlier, cooling for a second month, but still above, of course, the price target of 2%. But we do actually see as well the yen depreciation really fueling concerns that cost-push inflationary pressure could be here to stay, as you say, Haidi. So the core reading there, you're seeing 2.2% on the year. That was in line with estimates here. But really also playing into it perhaps is that slowdown in the rise in food prices as well. And we're also seeing perhaps businesses that are a little bit cautious to pass some of the costs on to consumers because they're aware of the cost of living pressures that are also building. So that's the state of play. You've got equities here down 1.5% today. It's not just the story of Japan's inflation, of course. You've also got US numbers that came out overnight, and we saw further resilience coming into the US economy, or signals of a strength. And so, again, we're seeing swaps. They're actually pushing out the expectations for Fed hikes to December now. That's fully priced in for the first quarter point cut for Fed officials. It was November just a day earlier, so a month there distance here. But as we said, equities 1.5% to the downside as we get underway this morning. Japanese yield as well, one to note, because you're actually above that 1% mark. It's something we've been tracking here. So rising just a little bit here, but that has been the really big trend that we've seen. So above that 1% mark, we're going back to levels that we hadn't seen before the experimental policy that was led by BOJ Governor Kuroda. Let's change on, because there's a couple of different stocks that we're watching here at this morning. One of those is Samsung, actually, and it'd be great if we could see that, because we're getting reports that it failed an Nvidia test due to heat. We can get more details on that as they arise, but we do know that Nvidia has been a very, or rather, Samsung has been a key supplier into Nvidia, and Nvidia is also working with Samsung for the delivery of HBM or high bandwidth memory chips. So you're seeing there Samsung off 2%. That's going to be not a great lead-in or indicator for the Kospi as it performs today, given that heavy weighting here. And you're seeing the Kospi, again, 1.3%. Samsung to note as well, because actually it was one of the top picks at the Seoul conference this year. Other Korean ones in play as well, Haidi.
Yeah, and we are seeing a picture of downside pressure when it comes to Australia as well, just in the first couple of minutes or so. And in fact, much of the trend that we saw yesterday, we're seeing the banks weighing, miners extending losses into another day. In fact, materials names and utilities are down by about 1% apiece at this moment. We're seeing a little bit of sort of potential for upside when it comes to energy, but we're watching that commodity story very closely. But there is a sense that perhaps after trading pretty close to record highs for the past few months, that outlook is looking a little bit more bearish for Australian equities. There's a great deal of economic uncertainty globally. Of course, the uncertainty over China's property market recovery has perhaps given a bit of a reality check after what we've seen as that rebound in the likes of iron ore, right? So consumer discretionary stocks in particular are pretty poorly placed in terms of that underperformance, according to some of the analysts that we've spoken to. Watching what we're seeing across Treasury yields surging, still data there showing the strength of the US business activity side, the tighter labour market. We're really seeing kind of traders being pushed back into pushing back that timing for rate cuts until the end of the year. So in particular, that sensitive two-year yield rising the most to the highest since about May 2nd there. Let's bring in our executive editor for Asia Markets, Paul Dobson, joins us now. So let's go back a step and have a look at the CPI numbers. Look more or less in line with expectations, but certainly probably not where the BOJ wants to see it, and probably won't be enough. And I guess there is starting that sort of creeping concern about the impact of the weaker yen now.
Absolutely, and that's the conundrum and the balance for the BOJ, trying to keep inflation around its target level, not having it come down too fast or too far, but also not blowing out too far ahead of target with a weaker yen only likely to exacerbate that. We're uncomfortably close to the levels where the BOJ, the MOF and the government authorities last intervened in the market to damp the weakness of the yen. We've been slowly ebbing back towards those levels. But remember, it's the pace more than the outright level that really matters. And the fact that we have had that little bit of a check in the depreciation of the currency over the past couple of weeks will probably give them some reassurances, So perhaps we're out of the intervention zone. But on the other hand, if you're looking at those key levels and where the next stopping off points might be, then that's something for everybody to keep in mind as well.
Paul, we're just we're very early moments of the session here, 5 minutes in, but we are seeing every single sector in the red. Is this that story around the concerns that we saw in the US session for the outlook for Fed rate cuts and the pricing? I mean, it's been pushed from November to December, so it's really just a matter of weeks. But why do you think investors are getting so spooked?
Yeah, well, it's a difficult one to unpick everything, but it seems like equities have been struggling a little bit of late. And, with the Fed being so data dependent, every new piece of information, every input that we get is tipping those bets on when the Fed's going to move and if the Fed's going to move one way or the other. I think this week was kind of noteworthy because we had those strong PMIs yesterday. That's not something that usually moves the market all that much, but because they were so solid and they came right after the Fed minutes, where more policymakers had probably been talking about the possibility of hikes than we might have expected, it's just giving everybody a little bit of a sense of caution again about that timing for the Fed, about whether central banks are going to have to do something more radical in order to get inflation under control, all looking out a long way into the future and beyond that turbulence that we'll have before then with the US election, for example. It's been a great month overall for risk, though. So on the flip side of it, as we're getting towards the end of the month, maybe people starting to be a little bit more cautious. The old sell in May and go away. If you'd done it at the start of the month, you'd be kicking yourself. But perhaps, maybe people are starting to think a little bit more about that trading, strategy, thinking about where will we go over the summer. If it's going to be choppy and volatile like this, maybe I'd rather take a few chips off the table.
Well, the other big question mark is really expectations for China. Right? We've seen Australia perform very well, particularly when it comes to the commodities-related kind of areas. But ultimately, this property policy doesn't seem to be a game changer. So is there a bit of a reality check when it comes to the broader recovery on either direct or indirect China exposure now?
No, I'm not so sure. I feel like the property sector is starting to come around a little bit. The latest measures, yes, analysts have said they're not sufficient. They certainly show a good deal of intent, right, to at least finally get to grips with this situation. I think if you look particularly at Vanke, the company, they've been under pressure of late. How that's turned around and how the banks have rallied behind it to support it does give me that kind of sense that there are more firm efforts here to try to get the property market under control and to start turning it around. Now, we know that that's going to take a lot of time because a lot of what it depends on is consumer confidence, and there isn't a great deal of that in the market at the moment. We're still seeing very depressed, bond market, very low deposit rates. On the other hand, if there is more of a will to finally kind of turn this around, then you could start to see signs that more confidence is gathering pace. And again, with Chinese equities, we've seen very big rally from the bottom now. Yes, we've had a little bit of a setback in the past few days, but there has been some renewed confidence. And, if we can hold at these levels and then start to gather a little bit more momentum, then perhaps that will bring in the retail investors, for example, which is one of the elements that's so far been missing from the rally.
That was our executive editor for Asia markets there, Paul Dobson. And we're just, as we said, heading through the morning session. So far, we're seeing a lot of equities in the red. But Samsung is one of those, actually, that we're tracking today because it's dropping 2.3%. There is actually a report that is behind that decline, and it's coming through from Reuters this morning. They're saying that Samsung's HBM chips. These are the high bandwidth memory chips are failing Nvidia tests due to heat and power consumption problems, and the problems do appear to be affecting the HBM3 chips in particular. That's the 4th generation HBM standard that's currently used in most GPUs for AI, as well as 5th generation HBM3E chips that Samsung and its rivals are bringing to market this year. So we know that there's been a lot of anticipation around Samsung being able to supply chips into the likes of Nvidia. HBM is a really key focus for them, particularly because they're a bit of a laggard behind SK Hynix. One to track very closely, that report there from Reuters. But you can get a roundup of the stories that you need to know to get your day going in today's edition of Daybreak. You can go to Daybreak Go on the terminal. It's also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get news on the industries and the assets that you care about. More ahead. This is Bloomberg. Well, hedge funds at the Seoul Hong Kong Investment Leaders Conference have been zooming in on opportunities in Japanese and South Korean companies in turn. And our next guest is actually positive on Hyundai Electric on the basis that electricity distributors and equipment makers, these are the ones that really stand to benefit from the AI boom. Shares you can see here were more than tripling over the course of this year. So let's get more on that now. Bring in Chris Wong. He's founding partner at Cloud Alpha Capital. And Chris, yeah, I mean, Japan was a really big flavour and takeaway from the conference, but we also heard a few picks from Korea as well, and yours was one that really stood out. But why are you focusing on Hyundai Electric in particular, and what was the sort of identification process that you went through?
Yes, because, with this raise of the AI demand, we think the world really needs electricity to support it. And the fun fact is one AI server will consume 10 times more electricity versus the general server we have used in the last 20, 30 years. And the reason behind is we are getting into new architecture by using GPU to, transit and to calculate the data and form, the old way, the CPU. So more electricity to support AI, and Hyundai Electricity is actually making one of the key components, which is called transformer. And they are one of the biggest supplier, and the most important is their competitor mostly is in Chinese. So as you might know, that to support the equipment on the AI, that especially in US, the US government right now is hosting, including the CSP, they are supporting that, the no China policy. So within the 30% of the supply has been taken out, we believe Hyundai Electricity was the best of the management and actually provide the best of the cost performance, can actually take shares in the future.
Okay, so let's just make sure we're clear here. So you're saying that the business that Hyundai Electric competes in around transformers, most of its competitors are Chinese, and you think that those are the companies that are at risk of being embroiled in this greater tech war between the US and China, could end up getting sanctioned perhaps, and Hyundai Electric is the one that really will be the one that stands to benefit as the non-Chinese company. Is that right?
Exactly. Yeah.
Okay, and so you're seeing big upside potential here, but are there any sort of concerns that Hyundai Electric, for instance, have you looked through their supply chain? Do you know, the supplies into them? Are there any concerns there that they could get as well swept up in those sanctions or that sanctions risk?
I don't think, at least from our understanding, especially we are actually getting into the election, the risk over there is a little bit, not put into the discussion. And the most clear reason is, with this AI, the demand is accelerating massively. Used to we have like 6 months to a year lead time for Hyundai Electricity to ship this high standard of the product transformer. But now the lead time actually extended to 3 or 4 years. Some customer we even heard they are willing to pay, 20, 30, or even 50% of the payment just to get the orders, which they target to ship 2-3 years after. So that a lot of signal just imply that the customer needed, because to develop AI, which is the key policy for every government and every corporate right now, that's actually essential pieces people wanted.
Chris, I was sort of looking through your bio and I thought it was interesting. You've worked within China for manufacturing, for precision manufacturing. And I do wonder, that experience and I suppose some of that insight, does it make you more interested in the opportunities on the China side of this tech divergence and the chip war?
Yes, because if you look globe, not only US developing the AI, right? The Europe, Middle East, ASEAN, and China itself also developing AI. So I think the supplier who's focused on this space will benefit. Everybody will benefit. The most important is this is actually not a new technology. This is a technology to support electricity transmission, the grid, in the last probably 100 years. Has been through the cycle many times. So the management team of this industry have the awareness that they should be cautious when the demand suddenly spike. That's actually the interest behavior we have seen in this industry versus the other industry we have covered in the technology. So that actually, the behavior will just leads to more demand-driven position for the supplier in the next 3 to 5 years. So I think globally, we do see a lot of opportunity, not just in US, but Europe, Japan, even some emerging areas like ASEAN or other places.
We spoke to one investor a little bit earlier on who said, look, AI, it is both a boom and a bubble, right? It is both a revolution and an evolution. And I suppose the question is, once we get past this first phase of it, what's your process for identifying the businesses, the sectors are going to benefit in the second phase, the third phase, as this technology progresses and as markets, sort of parts of the market saturates?
Right. We are just in a very, early innings on implementing the infrastructure for the whole AI development, right? So this is basically just like the second year. So people are aware that this is going to change our lives in the next 100 years. So we will need a lot of compute. We will need a lot of data center. We will need a lot of electricity. So this probably take, at least next few years, we are going to see the infrastructure to be ready. The most important is, even on the software side, the foundational model is still in the evolving stage to keep perform, and that's actually in a amazing speed. If you look at OpenAI, they launch the newest model in every 12 to 18 months, despite the difficulty has rising in multiple times. So after this becomes stabilized, I think the demand and applications will begin to have the real shape. So I do have the expectation that the demand will grow, but in a more linear way. However, the market we are talking is at least more than $1 trillion in our estimation. So that's actually the opportunity every company, every enterprise will not miss. So that's the reason why, in terms of the infrastructure, I think the opportunity can extend a little bit longer than people expect.
All right, that was Chris Wong there. He is founding partner at Cloud Alpha Capital, and as we said, came into the Sohn conference yesterday, had his stock pick, this Hyundai Electric, and actually sees the stock price roughly doubling from this point here. All right, we'll have more ahead on Daybreak Asia. This is Bloomberg. Well, Chinese Premier Li Qiang heads to Seoul this weekend for a summit with the leaders of Japan and South Korea in their first trilateral talks in about 5 years. For more, we're joined by our China correspondent, Min Min Lo. And Min Min, you look at these different countries, China, Japan, South Korea, what they all have in common is some big role one way or another in the chip chain. So is that really going to be the key focus, do you think, of the talks?
Yeah, certainly it's going to be a big part of the talks at a time when China faces this wall of restrictions from the US, the Dutch, from the Japanese as well. The US is really picking off the suppliers one by one of China. And we know Washington continues to court Korea and Japan to expand their limitations of this chip-making equipment exports to China. At a time when Korea is the largest provider of chips to China and Japan also also the largest provider of silicon wafers to China. So Premier Li, he will be using this trip to really shore up China's supply chain security. And it's big stakes for Korea and Japan as well, because they have big companies, Samsung, SK Hynix, with big presence in China. They will be worried about potential retaliation here. And time is of the essence, because Washington is said to be pushing for a deal with Korea on these curbs by June, before the G7 summit. And then the Japanese and Korean leaders, they're looking to perhaps visit the U.S. maybe in July for another Trilateral summit with President Joe Biden. So a lot of negotiations to be had before these meetings here to manage this relationship.
And it's not just chips, of course. There's other issues that are also at play. There's the military question. There's North Korea that's also in the picture. So what else are they going to be discussing?
Yeah, security issues in the East China Sea, South China Sea, that's going to be in focus, because we see Korea, Japan and the US, they are strengthening the security mechanism, holding joint drills in the East China Sea, where China, of course, have this territorial dispute with Japan over the Senkaku or Diaoyu Islands. They call these islands by different names. And then Taiwan also in focus, because we saw Japan send its largest ever delegation to attend the inauguration of President Lai Ching-te on Monday. Beijing obviously very angered by that. We saw those huge military drills over Taiwan yesterday. And in North Korea, as you said, a perennial issue for South Korea, that nuclear missile program, and recently allegations of that weapons for aid exchange with Moscow that both Moscow and Pyongyang have denied. But you can bet Korea and Japan, they will be pushing Beijing to really rein in Kim Jong-un and his missile program here.
Korean officials have expressed that this summit would serve as a turning point for the full restoration of three-way cooperation. Is that a pretty lofty hope?
Yeah, I mean, in the last 4 years since they held these talks, a lot has changed. And you really kind of see this geopolitical dynamics shifting fundamentally here. Because if you look at trade, China is still the largest trading partner for Korea and Japan. But when you look at new investments, though, that's declining from Korea and Japan in recent times. And if you look at exports, Korean exports to the U.S. overtook its exports to China for the first time in over 20 years. So it looks like the ground is shifting beneath Beijing's feet. But the good news is these three countries, they look set to still adopt a joint statement out of the summit detailing some of the outcomes. And we could look at perhaps collaboration in areas like science and tech, in dealing with climate change and infectious diseases. They could increase people-to-people exchanges, and also perhaps there would be efforts to further bolster trade and investment as well.
Bloomberg's China correspondent Min Min Lo there. Take a look at how futures in Europe are opening up for this Friday session, as we see quite a bit of weakness sustained across the Asia session. This sort of pull down to reality after the big Nvidia story, and some of the hopes of sooner rate cuts are starting to sort of peter out a little bit. Across Europe, we are seeing a bit of downside there. Stoxx 50 futures off by about 0.5%. We're also seeing weakness across German DAX futures there as well. It has been a point of sort of a week of difficulty for European stocks more generally. The loss of momentum really being carried through in the previous trading session as well. As soon as we got that US business activity accelerating, and as soon as that came through, we saw the Stoxx 600 index erasing those gains that were largely brought about by the exuberant reaction to Nvidia, of course. Also watching how currencies trade as well, given the move that we have seen both across Treasury yields and also the dollar. The sentiment issue seems to be the one that's weighing across global equities at the moment, as the enthusiasm over Nvidia starts to fade a bit. More to come here on Daybreak Asia. This is Bloomberg. Take a look how Japanese assets are trading at the moment. A lot of downside, particularly when it comes to the equity session. We're seeing all 33 subsectors, for example, in the topics falling. The data from the US, of course, being a major driver of that the Fed may stay higher for longer. All of that very much dampening broad risk appetite across the region, right? The biggest decliners, Toyota was one of the big losers that we're seeing. We're also seeing sort of quite a bit of pressure there from industrials as well. Inflation numbers also perhaps not helping the picture, cooling for a second month, but still above that BOJ price target of 2%. Well, in terms of how we gauge the market reaction and what the BOJ does about this inflation reading, it comes as the yen's recent depreciation continues to fuel concerns that cost-push inflationary pressures may be here to stay. Let's bring our Asia Economy and Government Senior Editor, Brian Fowler, who joins us in Tokyo. And Brian, this comes even as we've heard kind of murmurings from the BOJ that, yes, they are still on track. They're still committed to this normalisation, but the data is not exactly pushing them in the right direction.
Yeah, that's absolutely correct. So I guess there are two ways to look at today's figures. On the one hand, the main gauge slowed for a second straight month, and service prices, which are a key indicator of underlying trends, slowed to 1.7%, which was a bit of a surprise. On the other hand, the main gauge at 2.2% has now been at or above the BOJ's target for 25 straight months, and there are three big factors that would highlight upside risks in coming months. One is utility subsidies will be phased out starting in May. Those subsidies shaved almost a half percentage point off the headline figure in the latest month. So that would be an upward factor. We also have the weak yen, as you mentioned. There's some concern that that's going to start putting pressure on push pressure on inflation through imports. And then there's the wage hikes that we saw in the spring negotiations between Rengo and major companies. Those wage gains are in excess of 5%, which is the biggest increase in more than 3 decades. And we would expect those to show up in pay slips starting in around June. So with all that, the bottom line is that the BOJ probably is still on track to pursue normalization through another rate hike in the next few months.
But what is the path, do you think, Brian, ahead for policy normalisation? How many hikes are we likely to see this year? And is there really any defence in those hikes against the Fed, which most likely has a bigger bearing on where the Japanese yen goes from here?
Yeah, so, I mean, really the market consensus is fairly split. We've seen the most calling for maybe two hikes before the end of the year, but there are some who say that underlying inflation is starting to lose momentum, so maybe only one and done. And then we had an ex-BOJ chief economist tell us a couple weeks ago that he actually sees a case for up to 3 hikes before the end of the year, because it's really all about rolling back some of this excessive easing, not tightening policy per se, but just rolling back some of the excessive easing to a more normal state of affairs. So it's kind of hard to say exactly what we're looking at, but 2 would seem to be the main scenario that economists are looking for.
That was our Asia Economy and Government Senior Editor, Brian Fowler, there in Tokyo. And Japan actually was one of the key themes at the Seoul conference that took place last night. That was the Hong Kong Investment Leaders Summit here in Hong Kong, but gathering a lot of different investors and hedge funds together to talk about their key stock picks. And our next guest was actually one of the key speakers at that. He highlighted a lot of different activist opportunities in the country, and he focused actually on Kobayashi Pharmaceutical in particular. This is a drug maker that actually recalled health supplement products, which left 5 people dead and more than 100 in hospital. But with us this morning is Seth Fisher. He's founder and CIO at Oasis Management. And Seth, it's great to have you here in the studio.
Thanks for having me.
We can get to Kobayashi in a moment, but I want to start first because we were just discussing there with Brian, the reporter, about the outlook for Japan's economy, the outlook for the BOJ. And I'm interested to know, because you've been investing in Japan for so many years now and through so many different phases of the economic cycle, how much do you focus on the macro, and how much are you just looking at individual companies that you can target and then try and push them to make changes?
I spend almost all my time on individual companies, but when you add up everything I've seen in all these individual companies, you see real change and real both increase in focus on shareholder returns and increase in focus on profitability. And that profitability does flow through to wage rises, which was maybe affecting some of this inflationary data. And I can't speak for the overall macroeconomy. I tend not to focus on that. I tend to really focus on individual companies and what's going on there.
But at a macro level as well, because just with that inflation data, it also makes me think about there's a concern that's being highlighted by a Bloomberg economics team that some companies now might be reluctant to pass those price pressures onto consumers, given the cost of living crisis that a lot of people are facing. Is that something you see in the companies that you work with?
Absolutely. There's been a real reluctance to pass on pricing to consumers. the way to start that is actually raising wages, and then you get price hikes. There's still a continued phenomenon of prices haven't changed in many stores and many products for 30 plus years. So there's beginning to be the beginning and start of that. But also, we're a big proponent of raising wages actually across the board for employees.
And so that kind of feeds into the governance issue as well, right? And obviously the optimism over governance reform at Japan Inc. is one of the drivers of the recent rally that we've seen over the past few months. How much of that latent potential, as you call it, is yet to be realised still? You've said that there's now form, but are we yet to see much more substance?
Heidi, I think you're exactly right there. We've gotten the form now. Now we have to focus on the substance. There's enormous amount to do, and I think we're still in the very early innings of this. There's enormous, now that we have the form of independent directors at companies, they have to hold management accountable. There's still an enormous amount of room to improve margins at these companies. There's enormous amount of room to improve the leadership of many of these companies that are suffering some degree, sometimes under nepotism, sometimes under just a seniority-based system. And so, yeah, I think there's still an enormous amount of room to improve these companies.
There's also been optimism in nearby Korea, right, in terms of finally closing that valuation gap. And a lot of it has been on the same thematics that we've seen. Or perhaps if Japan is finally getting close to getting there, then there's hope for Korea as well. Obviously, still very early stage in that optimism. But is that one of the markets that perhaps you're also looking to try and replicate the progress that's been made?
Competition is good for everybody. You can see Korea started to value our project. They have a long way to go. We're spending a lot of time looking at Korea. We're spending only a little bit of time really investing in Korea. I think there's a lot of opportunity there. I think that there's a lot of developments that the regulatory environment need to be done. And so, the nice part about Japan is actually, METI, the FSA, the TSE all led the way. I think we have yet to see that in Korea. We're looking forward to that. We're spending a lot of time with the regulators in Korea, both in terms of how to improve it. There's an enormous amount of potential. There's different issues in Korea, but I think we're not even at the starting gate yet in Korea.
Yeah, big questions around the inheritance tax there in particular. But the stock, let's focus on what you were highlighting yesterday, which is Kobayashi Pharmaceutical. What was the process that you took to identify that stock in particular?
Sure. So we like companies that are both cheap and cheap on a standalone basis and cheap to their potential. And in this case, I think the company has a lot more potential. In terms of right now, it's been hampered by some real governance concerns. They've had 9 recalls in the last 10 years, more than any of their other competitors. I think that's because they're focused on, actually they need to find causation. But they state they need to find causation of when there's an issue with one of their products instead of just correlation. Actually, in a medical supplements business or an OTC drug business, you'd be happy just to hear about correlation and then issue a recall. So there's been a lot of governance concerns there. Look, we're at the 7th generation of the family running the company, so that also doesn't necessarily highlight the best of governance. And even the delay in this case of even reporting to the board. Right? You could have the form of independent directors, but if you don't tell them about it, then what can they do? So I think in this case as well, the board has to hold management accountable.
Yeah, because you were talking about corporate governance, there's scandals, there's nepotism that's present. There was another factor as well, yes. Or more factors, but you were talking about 3 different options that the company had to pursue. Which one do you think is most likely? What are the kinds of conversations that you're having with them? Because I can think for a 7th generation family company, it's probably not easy as well to enact any sort of change.
Look, I actually think it's easier than ever before because there's so many more allies and there's so much higher expectations of what management should be doing and what companies should be doing and what boards should be doing. Yes, so I highlighted nepotism, I highlighted underperforming management, I highlighted a board not holding management accountable, and so, and then I highlighted what the company could do. Right? And the company could go ahead. We've seen the apology from the company, and this is a serious apology. They could then go ahead and add to shareholder returns on their own, as we've seen in other companies like Enyos. And then I highlighted otherwise, they can go ahead and if they don't want to be held accountable, that's fine. They could do an MBO. They can go ahead and privatize themselves. There's been a massive surge in MBOs in Japan and privatizations of companies that don't want to hold themselves to the highest standards or want to just hand off management to their son. Ostensibly, it's always their son. And then they can go ahead and do an MBO, just pay minorities fairly and treat minorities fairly and treat all shareholders fairly. Or you can go ahead and we can work with them to improve that governance. That might be improving the board, and that there's other means we have also.
That last option, working with you, what's the probability that you're assigning to that, and also what's the potential upside in that sort of scenario?
I actually think in that scenario, there's the biggest upside of the stock, and for all stakeholders, I think it's like 70% plus upside.
Versus around
40% in the other two.
Yeah.
So I think the upside is the greatest. I actually think that at this stage, the whole shareholder base is ready to hold them accountable. So I think it's if we need to do that, I can't tell you which, as I put it yesterday, which door they choose. We just think they need to choose one of those doors.
Bigger picture question around investing. If you were to search Oasis, if you were to search by your name, actually, even on the terminal, you will see that you are working with so many companies across Japan. How many more do you have in your sights?
Oh, there are a lot of companies that we're working on, and that we're trying to do. We are long-term investors. We end up doing an enormous amount of work in these companies, and so we end up doing months, if not years, worth of work in the companies. I'm fortunate to have a very big team that can help us do that. And so yes, it ends up being that there's a lot of companies we're spending a lot of time on.
All right, that was Seth Fisher there. He's
Seth, we've
founder and CEO.
Spoken to you a few times now in
Management.
terms of. Seth, I wanted to wrap things up just by, obviously we've had these conversations with you all throughout the process and talked to you a lot about Japan. I do wonder, is it getting easier? Are the conversations kind of becoming more amicable? Do you think your overtures when it comes to dealing with some of these companies, especially new ones that you haven't dealt with before, is it becoming more of a two-way street?
Yes, much more so than ever before. They understand what we're talking about so much more than ever before. There's, as I used to talk about it 10 years ago here as well, like they hadn't yet gotten the memo. They didn't understand what we were talking about when we talk about corporate governance. Now that's very widespread. The expectations are higher as well, but invariably so many companies are working with us faster than ever before, and there's a massive acceleration in that engagement.
All right, Seth, we had a lot of questions for you there. That was Seth Fisher there, founder and CIO at Oasis Management, and we'll have more to come on Daybreak Asia. This is Bloomberg. All right, we're 45 minutes into the session so far, taking a look at how equities are performing, and it is pretty grim out there so far, down 0.6% on the broader benchmark this morning, but every sector's in the red today, and it really tells us that story around the changing expectations for Fed rate cuts. Actually, we're seeing those pushed out to December of this year after we had more data coming through overnight, and really just telling us that the US economy is pretty resilient, and so the Fed been not really in any sort of position to be looking to reduce their benchmark, and that's of course weighing on the pictures so far. Lots of different news also coming through company specific. We've been talking about the stock picks from Sohn, and actually Samsung was one of them, but today Samsung is also being affected by another report, and this is from Reuters actually this morning, which we may have actually matched now, but essentially we're hearing that Samsung is perhaps facing some issues around the heat that is being conducted out on its HBM chips, and so this apparently could have actually failed a test. This is actually from Reuters reporting here, but that would be a key concern, of course, for the company. HBM is a key growth area. It's lagging behind SK Hynix as well in the development of these key chips, and that stock today down 2.5%, Heidi.
Take a look, Belle, when it comes to some of the stories we're following. In corporate headlines, the US Commodity Futures Trading Commission is ordering JP Morgan to pay $200 million for supervision failures. The regulator says the bank failed to properly monitor billions of client orders between 2014 and 2021. In March, JP Morgan was fined $348 million by the Office of the Comptroller of the Currency and the Federal Reserve over similar gaps. Bloomberg has learned that SpaceX has initiated discussions about selling existing shares at a price that would value the company at around $200 billion. Sources say it would unveil a tender offer in June, with shares priced at around $110. A $200 billion valuation would be a premium to the $180 billion SpaceX achieved through its most recent tender offer. Boeing shares slipped after it scrapped a plan to generate cash again this year and warned of another significant outflow in the current quarter. Boeing says cash burn will be similar or worse than the prior period when it ran through almost $4 billion. Boeing's delivery woes have been compounded by China's request for additional certification on some aircraft parts.
The CAAC has asked for additional validation on a lithium battery in that recorder. And because of that, we have not been delivering airplanes to China recently.
India's biggest airline, Indigo, says it's planning to launch a premium product to attract first-time business flyers. That announcement came as the low-cost carrier reported quarterly profit that beat analyst forecast. The announcement underscores Indigo's ambitions to move beyond its current no-frills offerings.
If you see all the decisions and the steps Indigo have been taken over the past 2 years, it's really various building blocks which are nicely coming together. So we've started with more internationalization to increase our exposure. We've made a massive order of 500 planes last year. We had already the Airbus XLR on order, which can bring us further than today's planes can. And of course, in April, we made the big announcement for going into the wide-body space with the Airbus 350.
Taking a look at shares of Kobayashi this morning, they're actually jumping after perhaps, well, we just had an interview just now with Seth Fisher. He's the CIO and founder of Oasis Management. Kobayashi is a stock actually that he highlighted yesterday at the Sohn conference overnight. That's closed door, but highlighting Kobayashi as his stock pick and the one that could outperform over the coming 12 months. The reason he's focusing on this drug maker, it actually recalled health supplement products that left 5 people dead, more than 100 hospitalized. But Seth Fisher is someone who says that the ROE, the stock price, both of those have really underperformed, and he's looking at 3 options for the company Kobayashi. It can either bolster its board governance and shareholder returns, it can look to go private, or it can work with Oasis to improve its governance. And he says in that last scenario, actually Kobayashi could see 70% upside from here if it chooses to engage with Oasis. We'll have more ahead, watching that stock, of course, and a lot more this session on Daybreak Asia. This is Bloomberg. Segantii is said to be shutting down and returning capital to investors as it faces an insider trading investigation in Hong Kong. The closure would mark an abrupt end for one of Asia's largest hedge funds. Let's get more from Lulu Chen, who leads our Asia investing coverage. And Lulu, we know this has been a very, very closely tracked story, not only by people in the Hong Kong finance community, but globally as well. So what's the latest at this point in time?
Well, our colleagues have been told that the decision to return capital to investors came after the insider trading charges sparked concerns for a flood of redemptions. Segantii, as you mentioned, has a huge impact in the market. They managed almost $5 billion in assets as of last month, and they attracted global capital, global investors for stellar returns for a number of years. What's happening at the firm at the moment, the company has about 140 employees, mostly in Hong Kong, New York, and London. These people could be affected by the decision. Also, the SFC case is still in motion. So on the insider trading charges, more is to be seen as the case unfolds in courts.
Yeah, just an extraordinary turn of events, right? And we are seeing that this case, the insider trading case, is moving to a higher court in Hong Kong. Does that have implications in terms of what these charges are and what the potential penalties could be?
Yeah, so the estimation is, or the analysis is that by moving this case from the magistrate's court to the district court, they can impose sentences of up to 7 years in prison for convictions, compared with 2 to 3 years at the lower court.
Lulu Chen there, who leads our Asia investing coverage with the latest on Segantii. Just an extraordinarily turn of events for this firm. But something that we're watching is this order that we've seen from the likes of Citi, the likes of HSBC, to return to offices 5 days a week. We know a lot of us in media, Belle, obviously, even through the lockdowns and the darkest points of the pandemic, we have always kind of been in the office, right, other than a couple of stints of anchoring and reporting from home. But it's interesting that we've seen increasingly this pressure across Wall Street, across much of the corporate world to return to normal. And I think it's fascinating because I think there was one point, maybe during the pandemic, where the assertion was that this is going to change the nature of remote working or flexible working practices forever. That, and it is true, a lot of other businesses haven't and probably won't go back to full-time in-person work. But it seems like for perhaps some of these sort of traditional industries that we see across finance, that's certainly not the case.
Yeah, it's always as well that sort of stick and carrot approach. Are you going to try and coax people gently back into the office? And we saw that in the earlier days, or probably about a year or two, even 2 years ago, it was lunches being provided, transport being subsidised. But now it just seems like they're more going for the stick approach instead. We've got regulatory changes. If you want to keep your job, get back into the office. And now we're actually hearing, as we said, for those banks up to 5 days a week. And it's interesting because those are actually the banks on Wall Street that were known to be more flexible in allowing staff to continue working remotely after the pandemic. But as we said, it is that regulatory change, and it's actually coming through from the Finance Industry Regulatory Authority, which is set to reinstate pre-pandemic rules for monitoring workplaces in the coming weeks. So I guess for the HR at those different lenders, you can at least say, look, it's not us, it's government officials, and that's why you've got to get back into the office.
Barclays also one of the other banks weighing whether to require their scores of workers to commute back into the office as well. So it'll be very interesting, particularly across the sort of landscape for commercial and office real estate too, which took such a hit from work from home. But of course, as we round out this working week, we are taking a look at how the last session across Greater China, Taiwan markets as well as US futures are shaping up at the moment. This is a picture we're seeing a little bit of upside for S&P futures there. Quite a bit of pressure, though, for both Taiwan and China. In fact, Taiwan stocks have been holding up pretty well despite the start of some expansive military drills, the most in a year this week by China around Taiwan. So some of that geopolitical risk is really not weighing the benchmark TWSE index closing above 21,600 for the first time ever. When it comes to China, we're still seeing some of that downside pressure. This is Bloomberg.